So, good evening and a very warm welcome to all the participants who have joined us today for another exciting webinar on the important topic of awareness on commodity derivatives. Commodity derivatives are a critical component of the financial market, offering vital tools for managing risk and price discovery. We are honored to have with us today a very distinguished speaker, Mr. Somesh Vaidya. It's my privilege to introduce you to him. Mr. Somesh Vaidya is part of the business development team at MCX and brings with him over 20 years of experience with the commodity markets, including both commodity derivatives and spot market. Before joining MCX, he worked with various institutions and exchanges in the commodity derivative sector, where he gained extensive experience in product and business development. Sir, we are delighted to have you here with us. And without further ado, I invite you to take the lead and enlighten us with your expertise.
Very good evening, and thank you so much for your kind introduction. And yes, I am Somesh Vaidya from MCX, and as ma'am said that I've been in this market for last 20 years plus, uh, with experience in exchanges on the derivative side and some experience in physical spot side as well. So a combination of both spot and derivative side. So in today's session, what I'll try to do is I understand few of you attendees would have heard, would be aware about what commodities is. Some of you must be trading as well. So today's session primarily is on basics of commodity derivatives. Number one, what's the regulatory aspect? What are the products available for us on the exchange platform? And what are the important points which investors need to take care while trading in the financial markets? So that's very important. So I'll cover in my presentation these three, four aspects of commodities market. And in the end, once the presentation is over, we'll open the floor for any questions if you have. And please do let me know the feedback post the program is done, the webinar is done, whether you liked it, you need some additions to the presentation, you need some more information, so on and so forth. That we get to know, so that next time onwards we also incorporate those information in our presentation, right? So, friends, allow me to share the presentation and let me start today's session. So bear with me for next 45-50 minutes, and then we will take up the Q&A in the end. So, Raji ma'am, am I loud and clear, audible?
Very much, sir.
Thank you. Thank you.
The screen is also visible.
Great. So, a standard disclaimer, friends, that this is not a session to give you any sort of advisory. This is more of a knowledge sharing session and awareness session for you guys to understand what commodities are, and this knowledge added to your own research would help you to take an informed investment decisions in commodities market, right? So this by no means today's presentation would cover, if someone asks me questions about, sir, how good is, for example, gold or silver? So please pardon me from asking such questions. Okay. So let us first understand the regulatory structure of markets in India, right? So our regulator is Securities and Exchange Board of India, SEBI, which regulates equity markets as well as commodity derivatives markets. Commodity derivatives is also defined as securities, and hence it is regulated by SEBI. Under SEBI, there are exchanges or stock exchanges with commodity derivative segment. Like MCX is also a stock exchange, but only into commodity derivative segment, right? So there are stock exchanges. Under stock exchanges, you have got brokers, which are the market intermediaries, as we say. Okay, name any member or a broker. These are the members, and under those members are clients, right? So you as a retail client get registered through a broker, complete your KYC. Those members are associated with exchanges, and you can start trading in the financial markets, right? Why regulation is required, why there is a need for a regulator, so that there is any at point of time you feel that there needs to be a grievance addressal, then there is someone there who can listen to your grievance, and there is a resolution to that. And that's why it's always imperative for all of us to trade, invest in a regulated environment and not in an unregulated environment, right? As far as commodity markets are concerned, the exchanges were set up in 2003-4. Erstwhile Forwards Market Commission (FMC) was the regulator of commodity exchanges, but since September 28, 2015, commodities derivatives markets are also under purview of SEBI. Number one. Before 2015, what we were trading were only futures of individual commodities. So what do you mean by individual commodities? Commodities which are generally available in market. It could be gold, it could be silver, it could be wheat, it can be sugar, it can be soya bean, etc., etc., right? So these all are the commodities on which derivatives, futures contracts were available for trading. And in 2017, post SEBI took over the regulation. Over a period of time, they did a lot of developmental changes, one of them being options on commodity futures, which was launched in 2017. And that's where all the intermediaries merged their equity and commodity derivative segments. So today, most of the brokers offer under one single umbrella equities, cash segment, derivative segment, commodity derivatives, currency derivatives, so called, right? So these are all under one basket. And all universal all exchanges, single exchanges operating multiple segments, right? So like commodity derivative is a segment. So MCX operates just into commodity derivatives. We are yet not present into equity or currency side, right? Recently, now first few slides of mine presentation would generally cover nothing about commodities, but about financial markets, awareness about financial markets, how you want to trade. It is like uh, uh, when you start something new, you need to know what are the pros and cons both, right? So only after you understand the benefits and any issues, only then you figure it out whether this particular aspect of my investment or trading is doable or not. So first few slides I'm going to talk about not commodities but general awareness as an investor. When you are trading or investing, what you should know, it's very important for us to learn that, right? So this is the new SEBI investor website, which I believe each one of you have to go and visit and check. There are plethora of information available on this website about awareness messages, repository of videos informing clients about what financial markets are, how you need to trade, what you need to do for KYC, right? There are a lot of awareness programs also, which you can go and look at variety of locations pan India, right? So that also you can do. If any investor has any issue, then they can come and they can ask for necessary support, and you can give your feedback as well. There are financial tools and calculators. Personal finance and investment information is also available. So this is a very very good initiative by regulator SEBI to make clients aware about what commodity derivatives market are or financial markets are. There is a SEBI app as well, Sarthi 2, which gives you knowledge about educational videos, resources, what are the trusted source of investment, what are the reliable and essential insights into securities market, what as a young investor, how should you begin your financial journey, access to financial tools. So apart from website, app is also being developed by SEBI, available on Google Play as well as App Store, for you to understand and learn importantly about the financial markets, right? Reserve Bank of India, uh, I'm sure many of us receive hoax calls about payments to be done. something is due, please make your payment quickly, and so on and so forth. But at the end, we all understand whether it's genuine or not. So Reserve Bank of India has also taken up this initiative of awareness to client that you need to be alert when it comes to digital payment, right? You need to be alert about whether the link is genuine or not. So you need to be cautious. Basically, do not fall prey to any sort of false claims which helps you to somehow give access to your bank accounts or give access to your UPI details so that the fraudsters take away money from your account, right? So be pretty cautious about all these links which you feel it's not genuine. Recently, TRAI is also working very closely to make people at large understand that whether you receive any call which you feel is a fraud communication, you can complain it on Chakasu platform of TRAI. If the fraud is already happened, right, then there is a cybercrime help number and website as well where you can go and register your fraud, right? So these are few important initiatives which the departments and the regulators are taking for investors in general to understand that there are a lot of fraudsters in the market trying to take away money from market participants. In fact, every 15 days or fortnight I read in newspapers that because of some guaranteed return scheme which has been offered, that person was not registered investment advisor or a registered SEBI personnel under any of the category, and he has duped investors with crores of rupees. So these are few aspects which, as an investor, we should know what is genuine and what is not. So these are do's and don'ts which we need to understand, which we need to know when we are trading in the financial markets. Now, I'm not going to read each and every, explain you. Probably the do's are more, don'ts are only 15, but it's important for you to understand. It's available on the website of investor.sebi.gov.in as well as on the MCX website. But what is important is, do not deal with any unregistered intermediaries. You have to deal with your member broker. How will you find a member broker? It is available on exchange's website. You need to check whether the broker is SEBI registered entity. Is there a SEBI registration number or not? You can go and check that registration number on the SEBI website as well. Do not get into any off market transactions. It's illegal. It falls outside the jurisdiction of the exchanges. Do not enter into assured returns arrangement with any member. It's most important these days. A lot of scams are happening on this point, wherein some of the market participant is offering assured return of some percentage, say 18, 24, 24%, and you pay money, and after a few months the that person is absconding, right? So please do not get into assured returns arrangement. There is no concept of assured returns, right? Don't get lured away by any advertisement or hot tips or rumors or explicit promises of returns, right? That's not possible in financial markets. Do not make any payment in cash or towards margin or settlement of your account, right? Only make payments through legitimate mode. uh, Please understand the risk disclosure agreement which you are signing while doing your KYC. It's very important for you to understand what are the risks associated while trading in the financial market, right? Do not neglect to set out in writing any high value transaction if you are doing call and trade, if you're using call and trade facility through a broker. Okay, do not accept any unsigned or duplicate contract note. It's important for you to, of course, these days a lot of digitally signed contract notes are also available. That's valid, but still you need to have contract notes in your hand. uh, do not share your internet trading account and password with anybody. Very, very important. Nobody should know your trading account and password. We have seen, I have personally come across cases where uh, sharing of internet password, and the investor has lost money, right? So please do not do this. Okay. In case of delivery mode of settlement in commodities, you have to make payment for your goods that you have purchased. Do not delay any payment for that. Uh, do not forget to take note of the risks involved in your investments. In case of commodities you are selling, you need not sign the blank delivery instruction slip, right? You need to understand what you are delivering. Do not pay brokerage in excess of the rates prescribed by the exchange. Very, very important, right? Recently, SEBI has come out with a circular that all the exchanges have to charge flat charges to brokers, which in turn will charge one particular rate to a client because all clients are at par. So it is important for you to know what rates, transaction charges you are paying to your broker, to you are paying to exchange, you are paying to the government, you are paying to SEBI. Okay. And don't issue checks in the name of authorized person. Authorized person is basically a business partner of the broker or a member, right? He's an extended arm of the broker. You have to make payment to the broker and not to the authorized person. Please, these are the important don'ts which you need to really, really understand in case there are new investors in this market. There are a lot of do's over 2025. Uh, do your KYC, insist on a UCC, risk disclosure agreement, obtain a copy of KYC from your broker, insist on a digitally signed contract note, go through the rules and regulations and bylaws of the exchanges. So I'm not going through each and every aspect of do's and don'ts, but all this is available on the exchange website, and it's important for you to glance through and understand before getting into the mode of investment and trading, right? So who ultimately in the end is responsible investor? One who tracks markets, one who tracks economy globally and locally, one who understands his own financial limits and risk profile. This is most important actually. अ, हिंदी में हम बोलते हैं ना कि जितनी चद्दर हो उतना ही पैर फैलाने चाहिए. It's something of that sort, right? You should know your financial limit. You should know your risk profile. If you are a low risk profile participant, do not get into riskier assets. If you are able to manage risk, if you are able to manage the volatility in the market, then you need to have access to those sort of financial assets which you are able to manage the risk, right? Like as we say, we grow old as people start investing more into fixed return investments and not in riskier asset classes. Why? Because at that age, it's very risky to manage the volatilities in the market. Correct. So this is most important. Don't get into an over leverage mode or a greed mode in terms of, oh, मुझे ज़्यादा पैसे कमाना है, I'm ready to take the risk. Don't do that. Correct. Doesn't bet on the market but takes informed decision. Do your own research. डू नॉट ओवर ट्रेड कि भाई नुकसान हुआ है तो चलो मेरे को नुकसान रिकवर करने के लिए मैं और ट्रेड करता हूं, राइट? There's a possibility of losses getting multiplied, right? And continuously track your trading positions and investment position. This is most important. I mean, you just buy or sell something and you sit on it and do not track. Now that's not the right way to be in the market. You have to continuously track your positions in the market. So this is extremely important for you to know and understand what as an investor I'm supposed to do. Okay, so this is SEBI's new online dispute resolution portal, the ODR portal, which has gone live since August 11, 2023, wherein any investor having any complaint against a trading member, their member, they can lodge a complaint directly on the ODR portal, right? What happens is just go to this ODR portal, you lodge your complaint, the complaint is received by the exchange, and the exchange will reach out to the trading member, give him 15 days time, try to solve the case amicably between the client and the broker. If that does not happen, it goes to the ODR panel. Uh, Over their 21-day timeline is there. If the client is still not satisfied with the resolution of the ODR panel, then the case goes into arbitration. And finally, still, if the client feels that no proper justification is received, he can access court of law. Right. So this is what the new online dispute resolution portal is developed by SEBI, which has actually reduced the timeline for dispute resolution from few weeks to few days actually. So this is a very, very important initiative for investors, right? So this is what the flow chart is as far as the ODR is concerned. So you'll have access to this presentation. I'll share it with an ISM team, and you can, in turn, take it from them. So now, after understanding what are do's and don'ts of markets, what as a financial investor my responsibility is, so on and so forth, let's get into the actual topic about markets, right? So, when we talk about financial markets, broadly the markets are classified into five different segments: the capital market, the debt market, the forex market, the commodities market, and money market, right? uh, what is capital market? Basically, share bazaar. It's a market where the companies get listed. They want capital to grow their business, so they access capital through the investors, right? So investors apply in IPOs or FPOs of that company. They raise capital. The company raises capital, and the company gets listed on the markets, and the price of the share is traded in the capital markets. So this is what capital market is about. So it's about raising capital. Your capital, you are expecting it to multiply by way of share pricing increases, or you getting dividend from the company, and so on and so forth. So what is the role of the capital market? To raise capital from the market, basically, so that the company is able to grow and prosper from that capital that is being raised. Debt market, it's market of debentures or fixed income markets, basically, right? Bond market is also into a debt market, correct? Forex market, uh, market where currencies are traded. For example, in the import and export scenario of the country, what whenever we import something, the currency, the foreign currency goes out of the market. Whenever we export something, the foreign currency comes into the market, right? And the most common currency in import and export is US dollar. That's right. So forex market world over is the biggest and the largest market. Actually, it's not the capital market. That's fact, right? So because a lot of transactions, commercial transactions take place worldwide, forex market is the most active market world over. Then there is something called as commodity market, which we'll understand and learn more about its products in subsequent slides. And then there is a money market. Money market is basically liquidity, how much flow liquid money is available in the market, right? The overnight liquid funds and so on and so forth. So how the more the liquidity in the market, the money will flow into cheaper asset classes. Now who decides the cheaper asset classes? Basically the demand and supply of that particular asset class. Now if we try to analyze uh, all these five markets, somewhere or the other you will find that there is some linkage to each other. For example, when we talk about inflation, what we do is we talk about increasing prices of commodities. That's right. What is inflation? The price of commodities are on higher side. Higher the prices of commodities, the higher the inflation. So whenever there is a high inflationary scenario in the market, and because of increasing prices, there is a concern in the market with respect to the demand for that commodity. There is a concern in the market about how to tame the inflation, how to get the prices of goods and services on a lower side. So what happens is the Reserve Bank of India decides, okay, fine, because there is a high inflation in the market, there is a need to increase the interest rate, right? So commodity markets drives the prices in the market are visible from the commodities market because the prices are getting traded on the exchanges, right? It gives you signal whether the prices in the season which is upcoming will be on a higher side or on a lower side. If the prices are on a higher side, it gives a signal to the market, yes, there is an inflationary scenario in the market. It helps the Reserve Bank of India to assess, because of the inflation, there is a need to increase the interest rate. As a result of which, we have seen that interest rate in India, in US, in world over, because of high inflation, interest rate are kept high, so that the moment the interest rate are kept high, the purchasing power becomes low. So because the interest rate are high in the debt market, the percentage, the interest bearing securities, there is a demand for that because it's going to fetch more interest, right? As a result of which there is a lower supply of money because of there is an increase in the interest rate. There is a lower supply of money in the market. Lower supply of money in the market, the market participants, the people like us, would have a reduced spending capacity. We all know that whenever there is a rise in interest rate by bank, it hits our home loan EMIs, right? Why? Because home loan EMIs increase in line with increase in interest rate. Home loan EMI बढ़ता है, our money is flow towards EMI is higher, we reduce the spending on other aspect. We reduce the spending on other aspect, the prices of commodities start to cool off. That's right. So if you see properly, there is a linkage between commodities market, money market, debt market. Now, how is it linked to forex and capital market? Just imagine a commodity which India is importing. Example, gold. We all know gold direct in the form of coins and jewelry that we use. Uh, India does not produce any gold. We are second largest importer of gold world over, right? So when we import gold in this country, what goes out of the country is forex. So it has an impact on forex market. How? Because only when gold is imported, we also import crude oil. We also import coal. We also import chemicals. We also import coal for electricity generation, right? Chemicals we import. So there are a lot of imports in this country, as a result of which forex goes out of the country. So there is always a fluctuation in the forex market. Now just imagine if the price of gold in the international market remains constant, say $2,500, but rupee versus dollar in India goes up from 82 to 84. What is going to happen is per dollar you have to pay 2 rupees extra. So once you pay 2 rupees extra, the landed cost, the cost of importing increases in the country. The commodity becomes dearer. Crude oil, if it's trading at $80 per barrel today, and the price of US dollar to Indian rupee is 84, if the dollar remains same at $80, but the US dollar increases from 84 to 86, what has happened is per dollar there is an increase of 2 rupees. So I have to pay $80 into 2 rupees extra. 160 rupees extra, right? This 160 rupees extra makes the price of commodity dearer. Now, there are many companies in the capital market which are exposed to commodities. I'll give you one example only, just for reference purpose. Again, this is no guidance. A company like Titan, company like Vedanta. What is Titan into? They are into jewelry business, right? They consume gold. What if the gold price keeps on fluctuating? Vedanta, it's into metals. What is the price of aluminum, copper keeps on fluctuating, goes up and down based on the demand supply in the market, right? Uh, Oil companies, ONGC, BPCL, HPCL, what if the crude oil prices goes up and down? All these companies are exposed to commodities either as raw material or either as finished goods. So if the prices of commodities goes higher, the prices of raw material goes higher. You would have read in newspaper that because of increase in price of raw material, car manufacturers have increased the price of their cars, right? Because raw material महंगा हो गया है. What is the raw material? Aluminium, copper, steel, lead, etc., etc. So commodities market is actually giving you signals that what is going to be the economic activity of the country and how it is going to impact the money market, the liquidity, the debt market, as well as the companies which are listed in the capital market, right? So before understanding commodities market, let us understand first what is a spot market and what is a derivative market. So what is a spot market? It's a market where you buy and sell physical commodities. For example, you want to buy gold, you could go to a nearest jeweler shop. Okay, you give him money and you buy gold. That's a spot market, right? It's a ready delivery contract. Okay, so it involves producers, consumers, importers, exporters, processor, etc., etc. For example, the wheat flour that we eat, the farmer grows the wheat, from the wheat that is grown is taken to a nearest mandi or an APMC market where there are a lot of commission agents involved. Those commission agents then sell it to the purchaser. Then it goes into the company. The company buys it. Company grinds it and then makes a flour out of it, and we as a consumer consume it, right? So that's a spot market where you actually buy the commodity going by giving cash and purchasing the commodity. But what is a derivative market? What do you mean by a derivative? It's the price of commodity is derived from the prices of commodities in the spot market. If there is no transaction demand supply in the spot market, you cannot derive the price of commodity in the derivative market. In simple terms, what is curd, dahi? It's a derivative of milk. What is cheese? It is a derivative of milk. It is derived from milk, right? What is cottage cheese? It is derived from milk. Similarly, because agar milk ka prices change hota hai, upar niche hota hai, there is changes in the prices of these derivative products as well, right? So derivative market is not a market to buy and sell for immediate transaction. It is a market to discover the price of the commodity at a future date, right? These are the standardized contracts for you to come and participate as a buyer or a seller. And there are multiple buyers and sellers. In spot market, it is you and the opposite person. So there is a direct transaction between two parties. But in futures or a derivatives market, there are multiple buyers and sellers deciding to whether to buy or whether to sell. In case they want to buy, they will put in their own price. If they decide to sell, they will put in an own price to sell a commodity. So it's a platform for you to actually know, assess what would be the price of commodity going forward after a month, after 2 months, or after 3 months. And that's why futures contracts, the derivatives are known as futures contract. What will be the price in future? What will be the price of gold today on 30th of August? I am sitting, I want to know कि मुझे दिवाली में gold खरीदना है. By any means, do I have a mechanism to know what will be the price of gold in the month of November? Yes, you can go to MCX website, you can go online into the market data option, gold price October, you will get a price out there. Okay, the gold price for October month is this, which means please understand today someone is deciding to buy or sell for October contract. This is a derivative market. You are not actually buying a commodity right now, but you are just deciding on a price today for an October or a December month. So this is the fundamental difference between what a spot market is and what a derivative market is. So always in a market, there are four pillars, most important, right? To have a proper base. So commodities market starts trading at 9 a.m. in the morning till 11:30 or 11:55 in the night. What products, if I have a platform, I have to offer you products. What products are available? So there are futures of individual products and options of individual products available for trading. There are something called as index futures also, which are available for trading on exchanges, which are like, take it up later. If I have a platform, I have products, now I need to scout for people to make them understand how can they make use of commodities market. So we have day traders. Day traders are the one who wants to take benefit of movements in the market, right? The actual hedgers in the market. The arbitrageurs are the market participants who try to capture the price difference between two markets. Two markets mean the spot market and the future market. And there are farmer producing organizations as well, FPOs, who would like to come and hedge themselves or give delivery of their produce through the exchanges in agricultural commodities, right? So broadly, these are the market participants in the commodity derivatives market. And most important pillar is the policy, the regulatory policies for the development of commodities market. It is very important for a regulator to regulate the market as well as develop the market. So as I explained to you in an earlier slide, that what did the regulator do when it came over? A lot of risk management activities. Simultaneously on the development side, they allowed options, they allowed indices trading, they allowed mutual funds in the commodities market, they allowed AIF and PMS in the markets. So all these market participants came over in commodities market over a period of time, right? So I gave you an example of hedging in terms of why this market was developed. This market was developed actually for hedgers to manage their prices. I gave you an example of companies like Vedanta and Titan. They have got risk. How would they transfer risk? For example, we as an individual, we take insurance, we take health insurance, we take life insurance. So what is health insurance? That if something goes wrong, there's a company who's ready to accept that risk by paying me the money. So I'm transferring my risk to some person, correct? What is life insurance? If something untoward happens, okay, I transfer my risk to that company for by paying a small premium to that company. So I'm transferring my risk to somebody. In financial markets and derivatives markets, hedgers also need to transfer their risk. So whom do they transfer? Who are the people who can absorb that risk? Investors like speculators who want to speculate on the price of the asset, whether it's going to go up or down. Financial arbitrageurs, the mutual fund guys, the FPIs, the portfolio management services, so on and so forth. So these are the people who say, okay, fine, we are not actual users of commodities, but we just want to make commodity as an asset class for us to invest or trade. We are ready to accept this risk. And that's where the market is made up of a combination of hedgers and investors. And that's where how the liquidity in the market comes. The market participants come into the market looking at what others are doing, right? So actually, this is the most important slide for you to understand that what impacts commodity prices. We know if you are invested in equity market, how does the prices in equity market move, right? How does the prices of a share in equity market move? If company has got a large order, company is making profits, company has reduced its debt, its company has less promoter holding, so on and so on. Multiple reasons are there. But what about commodities? You need to understand that commodities are something which you can look, feel, see, understand, consume. All right. It's important for you to understand that there is something in commodities market where you can go somewhere in the spot market and buy and sell. But in commodities, there are certain commodities which we are totally dependent on the international markets. For example, gold, for example silver, for example crude oil, for example electronics, for example chemicals, right? So these are all commodities which India is dependent on international markets. Why? Because we don't have our own production. In agricultural commodities, we produce rice, wheat, corn, soya beans, millets, so on and so forth, potatoes, onions. We produce all this because we consume locally, but for certain commodities, we have to refer to the international markets. So whenever we are importing, whatever are the prices ruling in the international markets, we have no option but to use and import at those prices. So if the prices in the international markets are on a higher side, classic example is crude oil. Because we import a lot of oil, if the prices goes up from $80 to $100, we have to import at $100. Why? Because India is a consumption driven economy. We have to keep on importing to suffice the demand. So if the prices goes up, the cost of commodity increases. So most important factor is what's happening in commodities in the international market, especially those commodities which we are importing to a large extent. Forex rate, I already explained you. Geopolitical factors, global and Indian, it impacts commodities prices a lot. 2 years ago, on March 7th, when Russia-Ukraine war happened, uh, I mean, you all could, if you're tracking financial market, the prices of two commodities skyrocketed: oil and nickel. right? The nickel prices doubled within 2 days. Why? Because Ukraine is the largest producer of nickel. World over, people import nickel from Ukraine. Geopolitical factor, what's going to happen with Europe, what's going to Russia do with respect to oil and gas. There was all tensions as far as geopolitics is concerned. It went, oil prices went up high, right? So most important aspect, what's happening in Middle East as far as crude oil production and supply is concerned. Something goes wrong in Iran, what happens if to the crude oil production, right? So these are all geopolitical factors, be it global or be it Indian, the local geopolitical factors. It also impacts commodity prices. Trade policy and regulations by the government, for example, import taxes, dumping taxes on commodities, so on and so forth, right? It impacts price of commodities a lot. Economic factors, most important, what are the conditions in the economy, whether it's an inflationary scenario or a recessionary scenario in the country, right? So it's important for you to understand what are the economic conditions, whether it's a condition with high commodity prices, means it's an inflationary scenario. Commodity prices are trading on a higher side. How are the consumption pattern in the country, trends in the fast growing country, right? So all these economic factors impact commodity prices a lot because we consume commodities, correct? Commodity specific data points, like in India, demand supply scenario, like today's this season is a monsoon season. Post monsoon, lot of commodities will start coming in, like soybean, like corn, right? So and post winter, wheat and mustard seed and so on and so forth. So if there is any cotton, one of the largest crop of India, right? If there is untoward weather or unseasonal rain, there is a crop destruction, what's going to happen to the prices of commodities? It's going to shoot up. Why? Because the production is destroyed. So when there is a demand but less supply, the prices are going to go on a higher side, right? COVID-19 was a largest one of the black swan event in the markets, where we have seen that every single person stocked up to commodities for local consumption. We stocked up our groceries. We were not allowed to move out, so there was no demand for oil, right? So oil prices had fallen tremendously, correct? In India, most important from bullion perspective is the festive season, the wedding season, the religious sentiments, right? Everybody in festive seasons goes, buying for gold jewelry. There is a lot of demand for gold in the market, as a result of which we import a lot of gold, as a result of which the prices in their markets move a lot. So these are the most important factors for you to understand how commodity prices move in the markets in India specifically. Correct? So this is what I explained you about hedging. This I'm not going to cover in detail. So what are the active commodity contracts available for trading in the market? So regulator SEBI has notified 104 commodities where derivative contracts can be launched, right? As of now, we have roughly 10 commodities available for trading in at MCX. These 10 commodities are bifurcated into four segments. The bullion segment, which is gold and silver. Diamond is not yet available for trading. In energy segment, crude oil and natural gas. In metals segment, aluminum, copper, lead, nickel, zinc, and steel. In agri commodities, currently we have cotton, which is the most liquid contract, but there are other commodities also on which derivatives can be launched. Why? Because these are all commodities which are produced and consumed by multiple people, correct? So essentially the commodity markets are bifurcated into these four segments, like bullion, energy, base metals, and agricultural commodities. This is typically an ecosystem of the entire commodity derivatives market, right? The one on the right hand side, you can see exchanges. There are farmers, there are corporates, there are FPOs, wholesalers, importers, exporters, processors, traders, associations. They're all associated somehow or the other with the exchange side. But on the back end, what happens is, as far as agricultural commodities is concerned, there is a farmer who's growing the commodity. Okay, if he or any trader wants to come and sell goods through the exchange platform, a pure quality testing checking is done to ensure the goods are as per the exchange specifications. Only when the quality check passes, the goods are transferred to warehouse for storage. Against that storage, an electronic warehouse receipt is issued, for which a credit, okay, I deposit 10 tons of soybeans or 360 kgs of mentha oil or one bale of cotton into this particular warehouse. There has to be proof of deposit, right? So an electronic warehouse receipt is issued, and this electronic warehouse receipt is a negotiable instrument. You can go to a bank and take credit against that instrument, or you can come and sell it on the exchange platform as well. So commodities derivatives market, the ecosystem is much, much wider as compared to the other financial asset classes. So why commodities trading, or why you should get into a trading aspect of commodity derivatives? One, it's a derivative market, hence it's also called as a market for leverage, because you're not paying the entire money to buy the commodity. You're paying a small percentage, which is called as margin, correct? So that is called a leverage. So by paying 10% of the value of the commodity, you are actually buying an asset class worth lakhs of rupees, which I'll explain you in the subsequent slide, right? Liquidity in the market, yes, there is enough liquidity because there are multiple buyers and sellers who want to buy and sell in the market. Diversification, most important. If you read, a lot of financial planners these days talk about diversifying into asset classes. Do not put all the eggs in one basket. That's what we hear most of the times, right? So there is a need for diversification, because you never know how the markets are going to perform over a period of next 2, 3, 5 years. It's always better to diversify your investments. Inflation hedge, commodities are, I explained you about how commodities are, rising price of commodities is associated with inflation, right? So most important asset as an hedge against inflation or hedge against uncertain times is gold. There are a lot of theories that gold always acts as a perfect portfolio hedge against inflation, because it always generates returns a tad higher than your inflation. It takes care of your inflation aspect, right? And transparency, when you're trading on the exchange platform, you don't know who the opposite party is. For you, the opposite party is the exchange. You are coming on an exchange to trade, right? So these are the five sort of points for you why you need to get into understanding what commodity market is, and then subsequently trading if you feel, yes, this asset class suits my trading requirement. So what are the products available for trading in the commodities market? Futures and options, F and O. These are the products available for trading on MCX. Bullion contracts for gold, we have 1 kg contract, we have 100 grams contract, we have 8 grams contract, and we have 1 gram contract, right? Silver, we have 30 kg contract, 5 kg contract, and 1 kg contract. So what do you mean by a contract? So futures means, for a future date, I'm ready to buy 1 gram of gold, or I'm ready to sell 1 gram of gold for a contract which is expiring in the month of October or December or February 2025. So there are different variants of these contracts. So as an investor, my appetite is to trade a 1 gram contract. 1 gram is close to say 7,000 rupees. Okay, just for sake of understanding. But I am a investor who understands and have got a better capital availability. I can trade 8 grams or 100 grams because these are the larger contracts. Or maybe I'm an investor or a HNI who understands gold very well, and I don't want to trade smaller denominations, but I want to trade a 1 kg contract where margin requirements are very high. The contract is available for you to trade. right? So for every set of participant, we have contract available for trading. For silver, we have a 1 kg contract, which is a contract worth 80,000 rupees, then a 5 kg contract and a 30 kg contract. In base metals, we have aluminum, copper, lead, and zinc. These are the four contracts available for trading on the exchange. And then in energy segment, we have crude oil and natural gas as two contracts available for trading, right? In commodities market, options are also available for trading, like options on gold and silver are also available, options on copper and zinc are available, and options on crude oil and natural gas are available. As on date, energy segment is the largest uh, contributing product as far as volumes are concerned. So options volume are close to 80% of the exchange total turnover, and remaining 20% is futures, right? And that too in options, crude oil and natural gas are the most liquid and most actively traded contracts on the exchange platform. So let us understand a bit in detail about what the products are in the bullion segment. So as I explained to you, gold 1 gram contract, 8 gram contract, 100 grams contract, and a 1 kg contract. That's right. So gold 1 gram contract is called gold petal. We have monthly contracts available for trading. Okay, every month the contract expiry is there. The price quotation is rupees per 1 gram. So what do you mean by price quotation? That the price will move every 1 rupee. So suppose if the price of gold is 7,010, it can go 7,011, 12, 13, or 7,009, 8, 7, 6, 5. So every 1 rupee, the price is going to change. And since you are trading a derivative contract for an expiry of a contract, say at the month end, you pay a margin, which is close to 9.25%, roughly 650 rupees. So by paying 650 rupees margin, you can take a position in a gold petal contract expiring either in month of August. Okay, today is the last day of August, but either expiring month of September or month of October or month of November, right? Primary delivery center is Mumbai. What do you mean by that is that any client who wants to give or take delivery of a 1 gram gold petal can deliver the commodity from Vault located in the Mumbai center. Additionally, the seller can also give delivery from Ahmedabad and New Delhi. The last 5 days of the expiry of the contract is the delivery period. Like in equity spot market, you buy some shares today, it gets credited on T+1 or T+2 basis, right? In commodities market, though it is a derivative expiring on a monthly basis, last 5 days are typically the spot market. Okay, because the delivery starts from the fifth day of before the expiry of the contract. So be it for gold petal, be it for gold guinea, be it for gold mini, or be it for gold 1 kg contract, the last 5 days are meant for delivery of the commodity. Remaining days you can trade depending upon your view in this particular asset class. Then we have a gold guinea, which is an 8 gram coin contract. The price quotation is rupees per 8 grams. So if the price is roughly 57,716 rupees, the contract value is roughly 4,60,000, because and at 9.25% margin, the margin requirement are close to 42,000. The gold mini contract, it's a 100 gram contract. If the price closing price is 71,000 rupees, the contract value is 7,14,000 rupees at 9.25% margin. The margin requirement is close to 66,000 rupees. And gold 1 kg is a bi-monthly contract. It's not a monthly expiry contract. There are alternate month contracts available for trading. So if today in the month of August, if I want to trade gold 1 kg, I can trade October contract and December contract. I cannot trade November and January. Why? Because these contracts are not available. They are aligned to international markets. Same margin percentage, 9.25, but the margin requirement is close to 6.5 lakh rupee. So you see that despite the margin percentage remaining at 9.25%, different contracts have different margin requirements. So as I explained to you in earlier slide, what is your risk appetite in terms of trading? You want to start low, then you can go for gold petal contract, and then gradually you can graduate to a higher denomination contracts. Silver micro, again, 5 contracts available in a month. It's not a monthly expiry contract. So for example, we have contract expiring in month of March, then we have contract expiring in the month of May, we have contract expiring month of July, September, and November. Oh, sorry, December. Right? So these are the 5 contracts for silver, be it 1 kg contract, which is called silver micro, silver mini, which is a 5 kg contract, and silver 30 kg contract. For silver micro, the margin requirements are 16%, roughly 13,500 rupees. For a 5 kg contract, it's a 67 to 68,000 rupees margin requirement. But for a larger contract, roughly 4 lakh, 7,000 rupees is the margin requirement. Now, for except for gold petal, gold guinea, and silver, the primary delivery center is Ahmedabad. What do you mean by primary delivery center? Again, the center from which the price is getting driven at the time of delivery of the contract. So if any seller who wants to give delivery, primarily he has to give from Ahmedabad. Additionally, he can give from other delivery centers as well. Now, for financial market participants who do not want to get into delivery mode during the last 5 days of the expiry of the contract, SEBI permitted us to launch an index. So if you understand, in equity market, you have index like Nifty, you have Bank Nifty, you have Fin Nifty, you have Sensex, you have BankX. These are indices, right? Similarly, we have an index called Bullex, which is a cash settled contract. But Bullex derives the prices from price changes in gold and silver. 56% weightage is for gold and 44% weightage is for silver. When you combine these two products, you get a product, another derivative called Bullex, which is an index having price quote of 50 units. So if the closing price of index is say 18,000, so 18,000 per unit, and I'm trading 50 units, the contract value is roughly 9 lakh rupees. But you are paying margin of 8.66%, which is close to 78,000 rupees. Benefit of trading Bullex is that you can take position for both gold and silver put together without threat of delivery. The index will get settled and the difference is your profit or loss. It's a cash settled contract. It's not a delivery backed contract, right? For energy segment, we have crude oil and natural gas, 2 products available for trading. We have crude oil 100 barrel contract. We have crude oil mini, which is a 10 barrel contract. For natural gas, we have a 1250 MMBTU. Its MMBTU stands for million metric British thermal units. Also, it's a denomination for natural gas to trade in the markets, right? And for mini contract, is 250 MMBTU. So for market participants who wants to enjoy the higher or having a higher risk appetite, they can trade crude oil with a 100 barrel contract, because for every 1 rupee change, 100 rupees is what the profit and loss would be. P&L stands for profit and loss. For a mini contract for crude oil, every 1 rupee change, the price, the profit and loss is roughly 10 rupees. Now, since crude oil and natural gas both are very heavily volatile products, right? Locally as well as internationally, the margins are on a very high side. The crude oil margins are close to 34% and natural gas margins are close to 20%. And hence, there are financial margin requirements are roughly in the range of 2 lakhs for a crude oil major contract, 20,000 for a mini contract, 50,000 for roughly for natural gas a mega contract, and roughly 9,000 rupees for a mini contract. So please understand, despite these being a cash settled futures contract, you have a very high volatility in these 2 products, and as a result, the margins are also on a higher side. As far as base metals is concerned, we have aluminium, we have lead, we have zinc, we have copper. as four important products on which liquidity is available. Nickel and steel are also products available for trading, but they are not fairly traded on the exchange platform. And we have mini versions also for base metals, like aluminum, which is a 1 ton contract, lead, which is a 1 ton contract, zinc, again, which is a 1 ton contract. So for retail investors, smaller investors who want to invest a smaller margin amount, they can always trade the mini contracts. All the aluminum contracts are monthly expiries. Right from January to month of December, you can get this contract to trade. Now, over a longer period time, what we have analyzed is that commodities have an inverse relationship with equities market. So from 2014, the blue line is the price of MCX gold. The orange line is the price of Nifty 50. You can see that दोनों साथ में नहीं चलते हैं. They are always reversed. So if the price of gold is on a higher side, the Nifty would be on a lower side. It's showing a reverse trend. The classic example was COVID, the larger fall in the month of April 20. Everybody knows that when COVID hit us, the financial markets dropped drastically. Why? Because nobody knew what's going to happen. World economy was literally shut. As a safe haven investment, the prices of gold shot up to 56,000 rupees. But when liquidity started to come in the market, you could see a spectacular rise in equity markets and a fall in gold prices. Similar thing happened during your Ukraine war, right? The Nifty fell and gold prices shot up again. And off late, you are also seeing that the equity market is rising and the price of gold are coming on a lower side. Of course, there was a duty cut in a recent budget, and as a result of it, there is a drastic fall. But over a longer period of time, you could see that both these asset classes are inversely related. And hence, when I talked about diversification, this is an example of diversification. Why you need to diversify your investment, your money into different asset classes, so that over a longer period of time, if one is underperforming, the other asset class would help you balance your returns, right? If any participant wants to know, understand what are the spot prices, what are the actual market prices on which buying and selling is happening in the physical market, then MCX Clearing Corporation is polling the prices from the market participants twice a day. These are available on our website and as well as on the members trading terminals. Okay. Now, quickly, I'll go through options in commodities. Uh, uh, they are a bit different than what you understand options and equity market, because these are options on futures. In everybody in financial markets understand options on indices, right? Options on Nifty, options on Bank Nifty, so on and so forth. But in commodities market, these are options on underlying futures. So most important for you to understand is you need to understand futures market first to understand how to trade options market. So previous slides, I explained you what products are available, what future contracts are, and now we will understand what are options on futures market. So basically, what is an option? Okay, I give you an example of how do we protect our risk, how do we transfer our risk, right? So what do you mean by transferring our risk? I'm exposed to some risk. I need some party to take my risk and ready to pay small amount, which is called a premium. So options are compared to insurance. Why? Because you are taking an insurance against an adverse event to happen by paying a small amount of premium. The maximum loss is the amount of premium that you are paying to the buyer. So I am the buyer, okay, okay, and you are the seller of a product. So let us take an example to understand clearly what options are. Okay, I'll give you a very crude example. I'm a person who wants to buy a phone, a mobile phone. Okay, what I'll do is I'll go to a shop on day one, say, gentlemen, I want to buy a phone from you, and but I'll not take delivery right now. I'll take delivery after 1 month. So that the shopkeeper says, fine, you can come anytime and take it. Second day, I go to the same shopkeeper and say that yesterday I came, I want to buy a phone, but I've got a condition that if the price of phone increases after a month, okay, you still have to sell me at a same price. And if the price of the phone goes down, then I'll not buy for you. I'll not buy from you. So shopkeeper says that, well, this is a deal which is very confusing, but let me at least try that. You want to buy a phone from me after a month. If the price goes up, you will not buy from me, but if the price goes so if the price goes up, you will I'll have to sell you the phone at a lower price, but if the price goes down, you will not buy from me. So the shopkeeper says, fair enough, I'm ready to take this deal, subject to that you paying me 200 rupees right now for this particular transaction. I'm carrying a risk, right? After a month, what I don't know what's going to happen to the price of mobile. So for that, you need to pay 200 rupees to me. What is that 200 rupees? Is the premium. So after a month, if the price of mobile is say from 10,000 today to 11,000 after a month, okay, I as a buyer am an advantage that I'm getting a mobile worth 11,000 rupees at 10,000. What is my maximum loss? 200 rupees that I have paid. But on the flip side, if the price of mobile falls to 8,000 rupees, I'm not going to go to the shopkeeper, right? मेरा नुकसान कितना हुआ? The same 200 rupees premium that I have paid to the person, that is shopkeeper. So that is why people understand options trading as the premium amount, which is the maximum loss that can happen to you. Beyond that, there is no loss going to happen. So that is why for option buyer, the premium is the cost is limited to the loss, but profit potential is unlimited. You can make unlimited profit potential, right? So these are exchange traded options which are free from counterparty risk. Both futures and options combination can be traded for as risk management tool. Okay, there are market participants that can devise effective hedging strategies between futures and options. Offers better cash flow management. Why? Because you're just paying one time premium. As an option buyer, as an option seller, you have to pay the margin, the entire margin, and hence options are a low transaction, low cost, low capital intensive product. So there are two concepts in options: the buy call option and a put option. What do you mean by a call option? The buyer of the option, he pays the premium. He has got a right to buy. I have got a right to buy a mobile phone after a 1 month, depending on my own choice, right? So if the prices goes up, I have got a right to buy. The seller has the right to sell. He has the right to sell me the mobile phone at 10,000 rupees if the prices are more than 10,000 rupees. He's got no option. His only income is the premium that he has received. As far as option seller is concerned, he collects the premium. He has got an obligation to sell. If the price of mobile is 11,000, then he has got an obligation to sell me that mobile phone at 10,000 rupees. His only income is that premium that he has collected, right? So call option, when you are expecting the price of an asset class to go up, and put option is the option when you are expecting the price of an asset or a commodity to go down, right? These are few options terminologies. What is an option price? The price of the mobile phone, 10,000, which I explained to you. This is the option price. What is the expiration date? 1 month from today. What is the price? Strike price, the specified in the option contract. मैं कितने भाव पे मोबाइल फोन खरीदने को तैयार हूं. And then there is something known as intrinsic value. Intrinsic value is the amount by which the option is in the money. If I buy a option contract today expecting the price to go up, I pay a premium of 200 rupees. Tomorrow, if the price of commodity goes up, the option premium will rise from 200 to say 225 rupees. So I am in the money. My current market price is 225 rupees. I bought it at 200 rupees. The difference between the strike price, which is 200, and the current market price, 25, is my intrinsic value, the price at which I'm making my money, right? So these are technical aspects of options, probably for which we'll take another session in deep. But for you to understand options, these are few important terminologies which you need to understand. Okay, so these are the 7 contracts in commodity options which are available for trading, which is gold 1 kg and gold 100 grams, silver 30 kg and silver mini, crude oil 100 barrel contract and crude oil mini contract, natural gas and natural gas mini contract, copper, zinc, these are, and nickel. So these are the 7 option contracts which are available for trading on the exchange. Please note these are the options on futures contract. And as a result of which the expiry date of these option contracts are aligned to expire at least 2 or 3 business days before the expiry of underlying futures contracts. Okay, you have multiple strikes available for each product. For example, in gold and silver options, you have 25 strikes above the current market prices and 25 strikes below the current market prices. So the market participants who wants to trade, take a view for the price movement between those 25 strikes on the higher side and the lower side can take their view and trade in the market. For crude oil, we have 40 strikes available to trade. For natural gas, we have 30 strikes on the in the money and out of the money. What do you mean by out of the money? Market prices are tad higher than the current market price, right? These are the options devolvement concept, which is basically if I buy an option of say crude oil today at 6,000 strike by paying 100 rupee premium, at the time of expiry, if the crude oil price is 7,000 rupees, which means I'm making money, I'm in the money, my intrinsic value is higher. Okay, and I keep my position open in the option contracts. In commodities market, there is no cash settled options. The positions get devolved into underlying futures. Since you are holding your position till the expiry of the contract, you are in the money, you are making profit out of that particular option. Your position at the expiry of option contracts gets devolved, get transferred into underlying futures at the current market price, which is 7,000, for example. So you bought it at 6,000, your futures price at 7,000, 1,000 rupees is the profit that you make out of that devolvement into underlying futures. And once it gets devolved into futures, you can very well square off your position in the futures market, right? So how can you participate as a client in the commodities market, right? You have to choose a member broker, you have to fill up your KYC, understand the risk disclosure statement, understand the margin requirements which you have to pay to the broker, what are the exchange nuances in terms of rules, regulations and bylaws and etc etc. Understand the commodity and then select a product to trade. Most important, read do's and don'ts and understand and what are the brokerage and transaction charges that you're going to pay, what are the margins that you need to pay while trading, what are the default penalties, and something goes wrong, as I explained to you earlier, that there's a scores and ODR portal where you can raise a complaint for a better resolution, right? So please do all these checks before venturing into trading into any asset class actually, right? So these are the few investor awareness activities which we as an exchange keep on doing to make market participants aware about what commodity market is. We have our YouTube channels, we have social media channels. Please do subscribe for you to understand and get more knowledge about what commodity derivatives market are, right? It's in multiple languages. It's in English, Hindi, Gujarati, it's in Kannada, various different languages are there, right? So this is what a basic understanding of commodities market was from my side. Ma'am, I'm open for any questions if you want to take.
Okay, sir. Sir, actually, we have overshot the time, but
I
still
know,
we
ma'am.
can take one question. There is one interesting question from Mr. Abdul. So he has asked, Sir, as these times mandis are banned by the government, so how can we inspire general agrarians to go for future and forward contract for their products?
Can you repeat the question? Mandis are banned.
Yes, mandis are banned by the government as per Mr. Abdul. That
Mandi.
is
I doubt, ma'am, that mandis are banned because mandis are very well active, which
active, right?
wherein the actual buyers and sellers, in the where would the farmers get their goods? To the mandis, right? So
Right.
in the mandis, there are commission agents who buy and sell depending upon the quality, and then they decide the price, right? So mandis are not banned, madam. Number one, the prices in the mandi depends upon the arrival of the commodity in the market. Okay, uh, that's how the transaction takes place in the physical market. So it's a one-to-one transaction. It's a forward transaction between the buyer and the seller. Now, as far as the buyer is concerned, if he's going to buy the commodity and stock it from himself, and then he's going to sell at a later date, he's sitting on a price risk. So what he would can do is, if that commodity is available for trading in a derivative market, he can come and hedge his position. How would he do that? If he is sitting, he has bought a commodity, he will take a reverse position. What is his risk if the price is falling? Right? He has bought the commodity at 100 rupees, but if the price of commodity over a period of time, because there is a lot of arrival, is expected to fall, he can create a short position for that commodity into futures market. And this is how he is able to hedge his spot purchases. Later, after a month, 15 days, or whatever time period, he sells his commodities in the physical market. He has to immediately square off his position in the futures market. So, this is how typically spot purchases are hedged on the exchange platform.
Sure, sir. So there are a couple of questions which are related to the gold prices and the equity market.
Yeah.
So they are asking the inverse relation and also like sometimes why both gold and equity market both are rising
Go
in
hand
contrast.
in hand. Yeah, I'll
Yes.
answer both the questions. Of late, uh, uh, so yes, is there an inverse relation between gold prices and Sensex? So as I showed in the presentation, my last 10-year data over a long-term period, the gold and Sensex as a number, be it Nifty or Sensex, yes, they are inversely related. The prices are not in tandem. The correlation is very low, so we can fairly say that yes, these are inversely related. Why both gold and equity markets are rising today? That's because of huge buying by central banks of China. Last 6 months, the largest buyer was the Central Bank of China, as a result of which the gold prices have shot up tremendously. And as far as equity market is concerned, everybody knows there is a lot of liquidity in the market. There is a lot of funds available in the market, right? As a result of which there is a lot of money flowing into equities. So internationally, gold is rising because there is a purchase from the international side. As a result of which, as I told you, India is dependent on international market. The price also in India has risen despite a 6% duty cut in the budget. The prices fell, sorry, a 9% duty cut in the budget. The prices fell that day. But today, as I speak, the prices have gained back those levels, right? Because the prices have shot up in the international market. Plus, there are a lot of talks about interest rates in US market. Maybe it could be lowered. It's going to add some value, some fillip to gold prices internationally. It could, right? So yeah, inverse relation is certainly there, and gold and equity, both different fundamentals. Because of inverse relationship, they are rising on their own.
All right. So, thank you, sir, for enlightening us with a session to make commodity market easy to understand. And of course, we will continue this series of webinar about commodities market, and we will be announcing the upcoming webinar dates very soon. And I request all you participants to continue watching the upcoming webinars, which will be taken by Sir. And of course, you participants, you made this webinar a success. Thank you all for joining us here. And thank you so much, Sir, once
Thank
again.
you. Thank you, madam. Thank you, NISM, for organizing this. Thank you, participants, for being, available for an hour and a half. And yes, I'll share presentation with NISM. Madam, you have registration details of
Sure.
participants. You can please share the presentation with
We will
them.
do that.
And if you have any questions, please, later on, let me know.
Sure. Thank
Thank you,
you.
ma'am. Thank you.
Thank you, everyone. Have a nice evening.
Same to you, ma'am. Bye bye.